Hello everyone and welcome to today's morning market. So yesterday we focused around the news flow that was coming from the UK around Kwasi Kwarteng and him no longer being Chancellor on Friday. And then obviously yesterday we had Jeremy Hunt and we had the new proposed mini budget come through. So what has happened? What does that mean for me, but also for your money as well? So let's look at what's happened first. So firstly, you saw a massive reversal of the unfunded tax cuts that were proposed within the original mini budget. So let's just dig in and let's look at that overall. So firstly, you've seen UK corporation tax. So originally that was penciled to be reduced to 19%. That will now stay at 25%. For additional rate taxpayers, you will see that they will receive no reduction, so that will stay at 45%. The basic rate of income tax will stay at 20%, so it won't come down to 19%. Some smaller things, the freezing of alcohol duty will be scrapped from the original proposal, and also VAT tax-free shopping for international visitors, that will also be scrapped as well. But what will stay? So the 1.25% rise in national insurance will be reversed. There'll be no stamp duty on the first £250,000 of a property's value. If you're a first-time buyer, there'll be no stamp duty on the first £425,000 of a property's value. And the cap on energy prices, so the cap on the energy price bills, that will now run through to April next year, rather than October 2024 that was originally penciled in. But look, how did asset prices react? How did markets react? And they reacted positively. You know, what you saw is a rally in sterling. So sterling rallied against the US dollar just over 2%. So it peaked out around about the 114 level. If you look at what happened within UK government debt, so gilts, 10-year gilt yields fell back, so they fell back from around about 4.4% on Friday to just under 4% as at today. So you've seen a rally in gilt prices overall. I guess, you know, with the fiscal stance potentially going to be less loose than originally planned. I've got some research on this, and the tax U-turns equate to a tightening of around about 1.3% of UK GDP. What we're seeing is the risk premium on UK assets is falling. The Bank of England will be under less pressure to take an aggressive approach on raising interest rates. And actually one thing that I think is a real positive is market expectations on where the UK base rate will be next year have actually come down. So if you're looking at this, say 3 weeks ago, the market was expecting the UK base rate to peak out around about 6% midway through next year. That's actually come right back, and now the market is expecting the base rate to peak out around 5% midway through next year overall. So all else being equal, you know, this is good news for the economic outlook. But what I would say is obviously the tax burden will be higher than previously expected, and it'll put some pressure on households suffering from high inflation and falling real incomes. Overall, you know, we still expect the UK economy to shrink over the next 12 months, but I think yesterday's announcement means that a risk of a more severe downturn driven by the continued loss of market confidence has definitely been reduced. That's everything from me today. As always, we'll continue to monitor what is happening not just in the UK, but worldwide, and we look forward to reporting to you tomorrow. Thanks a lot. Bye.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.